right, here we go. Before we do these exercises, I just want to review. Remember, we've got this relationship of a wholesaler sells to a retailer, and they, of course, sell to us, the consumer or the customer, okay? Yesterday, we were wearing our retailer cap. Okay, here he is. And we've got our store, but we need stuff to put in our store. And so we were buying from wholesalers, typically in bulk. So we didn't have just one Under Armour sweatshirt, we had many of them. But that fine line of not having too many, because we only have the store, we don't have a place to put it. Okay? So when we are purchasing inventory, it's all masked as inventory. There's some physical things that I can see coming in and out, and there's some add-ons. So when we buy from this wholesaler, we are purchasing an asset called inventory. Assets have a normal debit balance. Opposite would be a credit, and it would reduce the inventory. So yesterday, I think we bought, let's just make it easy today. We bought $1,000 worth of stuff. We, the retailer, purchased it from a wholesaler. We were purchasing merchandise, also known as inventory, what I call stuff. Physical stuff we're going to sell. Now, even if I'm a hairstylist and I own a beauty salon, I still will buy stuff like shampoo, conditioner, stuff to sell to the customers. I gave the example of Town & Country buying Under Armour sweatshirts. The book talked about a stereo company buying stereo supplies. Okay, so that's a physical. I can actually see $1,000 worth of stuff coming in. But what if when it comes in, I had to pay for the shipping? So I, the retailer, actually it was FOB shipper. So as soon as it left that wholesaler, it became mine. And I also had an expense occur that was part of getting it to me. And that's probably where some of you got confused. Okay, there's an untouchable there. If I had to pay $25 to have that $1,000 of stuff shipped to me, that actually is an increase to inventory because it's bringing, I didn't get $25 of actual Under Armour sweatshirts. I just had to pay to get those to me, bringing the value of them up. Because really it's taking away from the bottom line. Okay, I got to sell sweatshirts for a lot of money to recoup my cost of buying them and shipping them to me. Now the reason I put that into different colors, I can't really touch that. It's not like I got $25 more worth of sweatshirts. It's just that the value of them went up because I had to pay because it was FOB shipper. Now had it been FOB destination, it would have been free shipping for me, and they would have owned it, and I wouldn't have seen this. Now oftentimes this is paid with cash, like when the FedEx truck comes. Okay. Now there's some things that reduce the value of inventory. Let's say 50 of them were junk. The Under Armour was on there crooked. Or there was a big hole in it. Or I just decided, that's ugly, I'm sending it back. In a case like that, I physically take that sweatshirt and I get it back to them. So then I don't have that much inventory anymore, but I can see that sweatshirt leaving me. There's another one that's kind of an untouchable. Let's say this was all on accounts payable. I said, okay, Under Armour USA supplier, I want these $1,000 worth of sweatshirts. Yeah, I'll pay the $25 shipping, but you know what? Bill me. Send me a bill. So here comes the bill. And on there are some terms that say 2, 10, and 30. What does that mean? Those credit terms. You got it. Carly said it right. If you pay within 10 days, I'm just saying it on the recording again, I get a 2% discount, but my whole bill is due in 30 days. Now that's probably not, I'm not going to do the math, but let's just say it's 10 bucks. Okay. That deal by me paying is actually going to reduce the value of the inventory. It's not really worth as much anymore because I got a deal on it because I paid sooner than later. 2 are touchable, 2 are untouchable. 2 are physical, 2 are like conceptual. Okay, did that help talking about it just one more time? Hopefully. Basically everything you saw up here is what we talked about all of yesterday. So I hope that helped. Let's put this into action here. Let's begin with exercise 5.1. I don't think that's in your workbook. And then we'll roll into exercise 5.2. Then I'll get out of your way and you can do another version by yourself. Hopefully you'll finish those and I can show you an answer key before you leave. Exercise 5.1. They're basically listing statements about all of this, and you have to say true or false. If it's false, we'd probably want to correct them. Mr. Etenmadi, I'm on page 253, has prepared the following list of statements about service companies and merchandisers. So remember, there is a difference. Service companies are like a lawyer, like a dentist. They're providing a service. Yeah, they might have some stuff that they sell too, but their livelihood is providing a service. A merchandiser is a retailer like your Town and Country, your Be Inspired, your Sweet Lilies. They're selling stuff. Okay. Oftentimes businesses dabble in both. Could we argue that Willys also provides services? Their livelihood is stuff, groceries, but they also provide services like carryout or delivery, or you can get you know, your bakery, you could argue, is a service and inventory. So we all know that typically you're going to be one or the other, but you might dabble in both. Okay. So we're trying to figure out, as we wade through service versus merchandising, what goes with what. Number 1, measuring net income for a merchandiser is conceptually the same as for a service company. True or false? True. I would say the merchandiser is a little more complicated. For the service, it's simply revenue minus expenses, hopefully equals net income. For the merchandiser, it's revenue minus what? COGS. We're going to get into that on Monday, what that means, what it looks like. That equals gross profit minus expenses equals, oh, sorry about that, net income. Now you might say, well, that's not at all the same, Mrs. Mars. Conceptually, it's the same. Money in minus money out is hopefully money in your pocket. Okay, it's just that the merchandiser has a little bit more, stuff wasn't free. So we've got to say that first, and then we subtract off our expenses. But overall, it's conceptually the same. For a merchandiser, sales less expenses is called gross profit. No, it's what I just showed you. Sales less COGS is gross profit. For a merchandiser, the primary source of revenue is the sale of inventory. Eli's nodding his head yes. He's right. Let me say that in different terms. For someone who sells stuff, the way they make their money is selling the stuff. Okay? Number 4, sales, salaries and wages is an example of an operating expense. Yeah, we got to pay our employees. Town and Country can't make money unless they have all the little employees with their red shirts running around. Okay? That's how they make their money. They pay people to sell it for them. My 10-year-old wants to be the guy in the red shirt, like now. Ethan wants to work at Town and Country in the worst way. So they need people, well, maybe not a 10-year-old, but they need people to sell stuff for them. Number 5, the operating cycle of a merchandiser is the same as that of a service company. The accounting cycle is The operating cycle is not. In other words, how long does it take for you to, as a retailer, to go buy the stuff, or in other words, the inventory, pay your bill, turn around and fill your shelves with the stuff, let customers come in your doors, pay all of your bills, bill them. So operating cycle, much longer. Accounting cycle, the same. Number 6, in a perpetual inventory system, no detailed inventory records of goods on hand are maintained. False. Every time they sell something, they know the COGS. They knew what went into getting that sale ready. Periodic is the non-detailed ones. Perpetual, it's ongoing. It's always being updated. Number 7, in a periodic system, cost of goods sold is determined only at the end. True. So perpetual is always being analyzed. Periodic, it's just at the beginning, what happened during the year, what's left at the end. Number 8, last one, a periodic inventory system. So they're only doing at the beginning what happened during the year and at the end, provides better control over inventories than a perpetual system. Not at all. If you're only periodically checking on things, who's to say an employee's not walking out of there with something? You don't know the fraud that happened. You have no control because you're only looking at it basically at the beginning and the end of the year unless you're adding more to it. That's tough. Like, that's a lot of terminology that we just went through, and you seem to get it. So good job. Let's do the next one. This does have a workbook page that goes with it. We're going to move right into the next thing on page 253. Information related to Harwick is presented below. So Harwick must be a retailer selling stuff. Retailer and merchandiser, the two go hand in hand. They're selling stuff. Where are they buying the stuff? From who? Who do retailers buy stuff from? Wholesalers. Yep. Oftentimes, if it's not being paid with cash, there's some credit terms that go with it, meaning shipping. Who's paying the shipping? FOB who? And what kind of discount is going to be offered if we pay within a certain time period? So those are what are called terms. How's it going to get to you? Who's going to pay for that? And if we pay early, what kind of deals are you going to give us? Okay. Prepare the journal entries for these transactions. So here we go. Is there an A and B section for you? Okay, sweet. First one. So remember, this is just retailer buying from a wholesaler. Do we have any customers walking in the door yet? We do not. That is what we're devoting to Monday and Tuesday in this class. Okay, now we've got the stuff on our shelves. Now let's open the doors and let the customers flood in. That will be a Monday, Tuesday thing. On April 5th, we've got to really pay attention to dates, you guys. Why do we pay attention to dates? Because of the discount period. Very good. On April 5th, we purchased merchandise. What account is it called when we buy stuff? Inventory. So don't be fooled by the word merchandise. It's actually inventory. It's not a debit to merchandise, it's a debit to inventory. So if we buy stuff from Botham Company for $23,000, are we really caring about the credit terms just yet? But later will we when we pay them? Yes. Okay, who's paying the shipping? It's FOB shipping point. We are. Are we worrying about that right now? No, because the FedEx truck hasn't cop slid into our building. Because cop slid meaning they've got so many deliveries right now that they're like, on to the next one. Probably not on April 5th would they cop slide in. All right. What did we gain here? Two things, actually. We got some inventory. That went up by $23,000. But what else went up? AP. Well, hold the show, Carrie Zitterich. Nowhere in there did it say anything about charging it or accounts payable. You're still right, because all of those terms are there. So you have to assume if there's terms that we've not paid cash, and instead we now owe them money. So you'll see that AP being credited like Carrie just described. Do you have some extra space somewhere on that page? Not a ton, maybe in the side margin. Let's just do a running total here. I'm going to make mine really small up here. What is our inventory account grown to? I'd put plus 23,000. Just as a little running total so we can see how inventory changes. What happened on April 6th? We paid our freight costs of that merchandise purchased from Botham. Why do we have to pay for it? FOB shipping. Remember, that's free for who? The shipper. We're the buyer. Okay, so in this case, we paid. Now, how did we, if I see the word paid, how do you think we paid? Cash. Okay, but right here, what was the shipping? $900, diapers. Okay, did that make inventory go up or down? Up. Does that mean I got $900 more of inventory coming to me? No, it's just that that's kind of some behind the scenes dollar interaction that's going to boost the value. So we see inventory increase by $900. We decided we paid cash though when that shipper arrived at our door. Oh, what are we buying on April 7th? Equipment on account. Honestly, they just kind of threw that one in there. This has nothing to do with inventory. I shouldn't say that. Like, what if the equipment is like a new pallet mover because we buy in bulk so much? Then it kind of does have to do with inventory, but it's not called inventory. Equipment is equipment. It's a different kind of asset. Well, of course, April 8th rolls around, and we finally get this stuff from Botham Company, and what was the problem? They had some damaged stuff, okay? So do we still have this $23,000 worth? But we minus how much? $3,000, okay? You're going to see accounts payable go down because we no longer owe $3,000 because we sent some back. It was damaged. Again, if I had to circle stuff, I can see 23,000 coming in. I can see 3,000 going out. The 900 was just, we had to pay to get it to us. Would we have that? Yes, Carrie. Yeah. Yep. They're like saying, you don't owe us as much anymore. Yeah, good question. What if, would the 900 be there if it would have said FOB destination? No. On April 15th, we paid the amount due to Botham in full. Okay. Did we pay within our discount period? We did. We bought the stuff on April 5th. 10 days later, on April 15th, we paid what we owed them. What was our original credit terms back up there in number 1? 2, 10, and 30. What kind of discount are we getting if we paid within the 10 days? 2%. What do we owe them? Remember, this isn't really, I mean, this made inventory go up, but we paid that in cash. What do we really should have been doing something like this. AP went up, AP went down. What do we really owe this Botham? 20,000. AP, we only owe 20,000. That went down. We wiped it out. Are we going to pay him 20,000? If it would have been the 16th of the month, we would have had to, but we paid within our discount period. Let's talk about cash first, and then I'll come up to inventory next. Well, wait a minute. I owed him 20 grand. Why am I only paying him 19,600? Because of the discount. So we owe them 20 grand times the 2% discount. You see inventory credited because it's devalued now by that discount. The 1 debit equals the 2 credits. I want to read to you just a little paragraph on page 224. When the buyer pays an invoice within the discount period, the amount of the discount decreases inventory. Even the book stops and says, why? Because companies record inventory at cost. By paying within the discount period, the buyer is actually reducing the cost. This will make even that much more sense Monday, Tuesday, when we start selling this inventory to our buyers or the customers. And although we got $23,000 worth, we returned some, we increased its value by getting it to us, we decreased its value because we paid early enough and got a discount. Because all of this inventory is going to roll into cost of goods sold. We're selling this good, this inventory. What did it cost us? It's this full story. Costed some to get to us, increasing the value. We saw a hit because we paid, but who cares? Overall, we need to know what the cost of the goods that we're going to sell on Monday, Tuesday. So it all comes down, I'll read that again. Because companies record inventory at cost, and by paying within a discount period, we're reducing its cost. That's it. There's a B part. There's a B part. Assume that, so I'm just at the very bottom of page 253. Assume that Harwood Company paid the balance due on May 4th instead of April 15th. 20 grand, 20 grand. Why did they not get a discount? They paid too late. They didn't pay within the discount period. That's it. How are you feeling about it? I knew it would make more sense when we did it. Yeah, but, and again, even the book kind of poses the question, why? So it answered that question on page 224 of your book. So I am going to give you another round of this, okay? Why don't I just bring it up on your screen so we can talk about it together. You can pass these out. They're not 3-hole punch, so you can 3-hole punch them if you want to. So I've actually given you some extra work for next week as well. It's all on one page. We'll let it open up here. Here it is. So do these two today. Save this for next Tuesday, because this is exactly what we did with, this all pertains to lecture 5.2. This is going to pertain to lecture 5.3. This is the retailer buying from the wholesaler. Down here, this is the retailer selling to the customer. Don't do this bottom part today. Wait till Tuesday. I just thought I'll get it all to you on one piece of paper. It's going to be easier. So what I'd like you to do is, you have plenty of time. You'll be done here in 10 minutes, even less. Work through this 5.1, 5.2 with these B sets, and then I'll show you the answers so you can just make sure you got it. You will have to use your notebook exclusively just because it doesn't have any worksheet pages. So I'll pause our recording and I'll come back with the answers in a bit. Okay, let's take a peek at some answers. We'll start with the 5.1. Can grab a sheet here. Measuring net income for a merchandiser is different than that of a service. False. We've decided that net income is still net income. Overall, it's taking a look at money in minus money out. We just have to take a couple minus outs, meaning minus cost of goods sold and minus expenses for the merchandiser. Number 2 is true. Sales minus cost of goods sold is gross profit. Number 3, with it being false, merchandiser's primary source is not that of services. So think of the Willys example. Yeah, Willys provides some services, but it's not their livelihood. Their livelihood is selling groceries, stuff. Number 4, false. Interest is an example of an operating expense. Operating expenses are what you will learn. Interest doesn't fall into that. It's other expenses or other revenue. We'll actually talk about that when we get into the 5th section of the book, when we do the kind of more complicated income statement. So that one was a little bit tricky, being that you haven't talked about that section yet. Number 5 is false. 6 and 7 being true, and then 8, a periodic inventory system provides a better control. No, it's always better to continuously, or on a perpetual, from a perpetual standpoint, track stuff. What questions can I answer about any of that? Other than the number 4 was kind of a weird one. Here are your journal entries. I won't go through them because I did the first time. Why are we seeing a credit to inventory in number 5? Who feels like they can explain what that means? What do you mean? The inventory is leaving? So the cost of it is going down. Yep, good. The whole cost thing will make so much more sense Monday, Tuesday.